Hello, Super Saver. I hope you're having a good week so far. In today's video, I'm going to talk about the top 5 money to-dos right now to protect and grow your hard-earned cash during these uncertain times. It's what we've done with our own money over the past week after the sudden meltdown of Silicon Valley Bank, SVB, and it's also what I've done with some of our clients' money. In the process of going through these 5 money to-dos with you, I'll also answer some of the most frequently asked questions and comments you've sent our way post-SVB collapse, including why rates on T-bills, notes, and bonds have gone down recently, how we're investing our money right now, and who insures Treasury securities, bank CDs, and brokered CDs. So let's dive in, my financial friend. Flee to safety. And no, this isn't a Top Gun joke or retire to an island proposal. Rather, flee to safety is my response to these 2 popular questions: why rates on T-bills, notes, and bonds have gone down recently, and how we're investing our money right now. To answer question 1, rates on T-bills, notes, and bonds have gone down recently because of a phenomenon in the industry known as flight to safety, meaning that during times of uncertainty, investors flock or flee to the safety of Treasury securities. I talked about this flight to safety concept in depth in an earlier 2023 video on how to invest during a debt ceiling crisis. But here's a brief recap. This chart here shows Treasury prices versus the S&P 500 index when we hit the debt ceiling the last time during the 2019 Treasury fiscal year. This red line represents the S&P 500 index, and this yellow line represents the price of the 10-year Treasury note. And this gray section here shows the partial government shutdown period. As you can see, during this peak period of uncertainty, investors temporarily hopped out of the stock market and into what they perceived as safer, longer-term Treasury securities, driving the S&P down and the price of the 10-year Treasury note up. And this happened despite the looming prospect of a U.S. default at that time, which can only mean that the markets didn't seem to price in any likelihood of a U.S. default. This flight to safety also happened during both the 2011 and 2014 debt ceiling crises. Again, a strong indicator that investors see treasuries as the ultimate safe haven. And not surprisingly, this flight to safety, where treasury prices go up when markets are in turmoil, that's what we saw during and in the aftermath of the SVB blowup. Because remember, when treasury prices go up, yields go down. And boy, have yields gone down the past few days, as we can see from the daily Treasury par yield curve rates at the time of this taping. Let's scroll down a bit. Here, before the SVB meltdown, Treasury yields were either inching upwards or relatively stable depending on the maturity. In fact, with the latest bout of economic data and Powell's testimony to the Senate, I and a number of other folks in the industry were already seeing the odds of a 50 basis point rate hike in this month's Fed meeting. That's what pushed the 13-week T-bill above 5% for most of this week here. And then here, March 9th, in the late afternoon, SVB suddenly collapsed and the market started to break down. And here's what happened after the sudden meltdown. People pulled their money out of equities, some even out of their own bank accounts, and fled into the safety of treasuries, driving up demand and therefore the prices of treasuries across the board and bringing treasury yields down across the board. More people simply wanted to buy treasuries because they were looking for someplace safe to park their money after the recent round of bank failures, which brings me to the next question here: how we're investing our money right now. In our retirement accounts, we're still mostly dollar cost averaging into equity markets, given our time horizon and risk tolerance. But any additional cash and even part of our emergency fund, surprise, we're still laddering into short-term T-bills, like we've been doing for quite some time now. And as I talked about in this update video from a few days back, and like many are doing now post SVB collapse. While there has been some discussion that the SVB debacle may prompt the Fed to go slower on rate hikes, or perhaps not hike at all in this month's meeting, the fact of the matter is that the Fed is still a long way off from its target inflation rate of 2%. So any slowdown or pause in rate hikes will only be temporary, in my mind, in order to give folks time to digest the SVB disaster. I'll have more on this topic later this month. For now, let's move on to money to do number 2. Be careful of any CD, savings, or other investment vehicle that sounds too good to be true. I've seen the emails and videos that some of you have sent me about CDs paying 7% and other quasi-safe investments paying similar or even higher rates. Like my husband Marcus always says, if it sounds too good to be true, it probably is too good to be true. Because I can tell you, based on our experience and market research, the top rate currently in the market is around 5% for a 1-year CD. And personally, I think it will most likely stay around that level at least until the Fed's meeting this month and the decision that comes out of it. Also, many thanks to all of you who completed this survey. The winner here was Capital One's 11-month CD at 5% APY that we already talked about extensively on this channel. The Capital One offer has already expired, unfortunately. But if any of you know of other great offers, do send them our way so that we can review them and share them with other super savers here. Right. So if there's a financial institution offering you a 7% or even 8% APY CD or other quasi-safe investment when the market rate is 5%, this should raise some eyebrows. Banks usually offer above market rates for 2 primary reasons. 1, they want to attract more new clients, and or 2, they simply need the money. So if you see an offer that sounds quite a bit better than what you're used to, be careful and do your research on what you're getting into and who you're getting into it with. And always, always read the fine print. Even if the bank making the stellar offer is FDIC insured, for me, when in doubt, my general preference is to not get involved with a smaller bank promising a significantly higher than market rate, not knowing what that bank's ultimate reason is for offering that above market rate. Because you know who also paid very high rates? Silicon Valley Bank, 4.5% APY on a business account. Wow. If I hadn't grown up in banking, I probably would have been tempted by this offer, which is a great segue into money to do number 3 in such times of uncertainty. Double check that your bank is FDIC insured and make sure that your deposits stay under the FDIC's standard insurance limit. Now, I know there are different opinions in our Super Saver community about whether or not the government and the FDIC should have guaranteed the return of all deposits in the recent bank failures, even those that were above the FDIC threshold. But regardless of how you feel about that, or how I feel about it for that matter, I think what we can agree on is that the FDIC and the government acted quickly in returning depositors' money. And that's why double checking that your bank is FDIC insured is so important. You can typically find this out by just going to a bank's website or branch. But if you want even more certainty, go to this Bank Find Suite tool on the FDIC website. If we scroll down, here we can search by bank name. I'll enter Silicon Valley Bank here. And here I'll enter California. And then I'll click search. And here are the results. I can see that they've been FDIC insured since October 1983. And if I want more details, I can click on this button here. Now, many super savers on this channel already know that the FDIC's standard deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. Check out this video here, which I've also linked in the description below, if you want more details about what this means exactly and how you can increase your FDIC coverage with your bank in certain instances. Because while the government did cover all deposits at the recently failed banks, there is no guarantee that they will continue to do so if there are further bank collapses. And I can tell you from firsthand experience speaking to some VCs and startup clients last weekend, you'll be in the "I'm sleeping so much better at night" boat if you stay under the FDIC's coverage threshold. Also, quite a few of you have asked about how you can check the credit rating of your bank. Most of the leading banks have this information publicly available on their website. This here, for example, is the credit rating for JP Morgan Chase Bank of North America, the largest bank ranked by consolidated asset size according to the Federal Reserve. I've included the link to this in the description below, as well as the credit rating detail for the next 3 largest banks in the US according to the Federal Reserve. The thing to note about these credit ratings is this. Sometimes when things happen fast, like they did with Silicon Valley Bank, these credit ratings may not help you much. In the case of SVB, for example, their downgrade by credit rating agency Moody's was announced to the public only on Friday, March 10th, the same day the trading in SVB's stock was halted and the FDIC shut them down. Privately, though, according to Reuters, Moody's had already contacted SVB management a week earlier to inform them of this upcoming downgrade. And some speculate that this private conversation was actually the beginning of the end for SVB. Just so you know, this private notification seems to be a typical standard practice in the industry, as companies generally pay for the credit agencies to rate them. I'll do a full SVB deep dive in one of my next videos if there's enough interest in the community. Drop a comment below if this is something you'd like me to explore. For this video though, let's focus on the more important thing of what you and I should be doing to protect and grow our money right now. So a bank's credit rating, while it might be an indicator of financial health initially, be aware that when things go south, they can go south really rapidly, as we've seen with this month's events. And a bank's credit rating should only be one of many factors that you take into account when considering a bank's financial health. Ultimately, you should ensure that your bank is FDIC insured and that your deposits stay under the FDIC standard insurance limit first, and then look at the credit rating as an additional source of information. Also, keep in mind that credit ratings may not be available if you bank with a smaller financial institution. Now, let's move on to money to do number 4 in such times of uncertainty, SIPC protection. Double check that your brokerage company is an SIPC member firm and make sure that your deposits stay under the SIPC standard coverage limit. The SIPC insures security holdings and cash held with brokerage firms, just like the FDIC insures deposits and CDs held with or issued by banks. To see whether your brokerage company is an SIPC member firm, again, like with FDIC coverage, you can typically find this out by just going to their website or branch. Another way to do this is to visit the SIPC website and click on List of Members here. And this is the page that appears. Now I'll click on F here to see whether Fidelity is an SIPC member firm. And here's the list of SIPC member firms that start with F. And I'll just scroll down until I find Fidelity here. The limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. Here are the top 3 things you should know about SIPC protection if you own treasuries and brokered CDs via a brokerage company. 1. SIPC protection is not based on the number of people on the account. So for example, if you and your partner have a joint account at Vanguard, the limit of SIPC protection on that joint account is still $500,000, including the $250,000 limit for cash. It's not doubled because there are 2 owners on the account. Here's the second thing you need to know about SIPC protection. Treasury securities are covered under SIPC if held in a brokerage or retirement account at an SIPC member brokerage firm. Here's what this means and what it doesn't mean. What it means is that if your brokerage firm goes bust, the SIPC will typically return the Treasury securities held at that brokerage firm to you. Those securities should still be in your brokerage account in any case, but even if they've gone missing for whatever reason, the SIPC will usually replace them. And in certain cases, the SIPC may return in cash the amount that the Treasury security was actually worth on the date that an SIPC claim was filed, rather than the security itself. What it does not mean, because I know this question will come up from those of you who are worrying about a possible U.S. default, what it does not mean is that if the U.S. defaults, the SIPC will give you your money back. Per the SIPC, they do not protect against the decline in value of your securities. And here's the third thing you need to know about SIPC protection. Brokered CDs are covered under SIPC if held in a brokerage or retirement account at an SIPC member brokerage firm. Again, this means that if your brokerage firm goes bust, the SIPC will generally return to you the brokered CD that you held at that brokerage firm, or in some instances, the cash equivalent of what that brokered CD was worth on the date that your SIPC claim was filed. If, on the other hand, the bank that issued the brokered CD goes out of business, but your brokerage firm is still in business, then it would generally be the FDIC who would be responsible for making you whole. And this assumes that the bank that issued the brokered CD that you bought from your broker was FDIC insured. So here's a list of securities that SIPC covers, and here's what it doesn't cover. As usual, I've linked this SIPC page in the description below. Now, if you're interested in me doing a deep dive on SIPC protection in one of my next videos, then please also drop a comment below and let me know so I can prioritize things properly for all of you. For now, let's move on to money to do number 5 in such times of uncertainty. Set up an extra bank account at an FDIC insured bank. So, the SVB meltdown weekend was also the same weekend as my son's birthday party. He ended up with some not so tasty 7-Eleven pizzas ordered last minute and a chocolate glazed Dunkin' Donut with one rather lonely candle on it. Because what we were busy doing for the better part of that SVB meltdown weekend was move our money and our clients' money around a little bit. Some of the startup founders that got their money out the fastest from SVB pre-FDIC shutdown were those that had a second bank account elsewhere, and to which they could transfer their above the FDIC threshold deposits out quickly. Other startup founders who didn't have a second bank account simply had nowhere to move their money to as fast. Now, I'm typically a financial minimalist, meaning I like to keep the number of bank accounts, credit cards, and financial stuff in my life as simple as possible. Well, that's changed slightly. We now have our emergency savings spread across 2 banks, not because I expect my primary bank to fail, nor because I don't trust the FDIC to return my funds quickly if something bad were to happen, but because, well, if my primary bank were suddenly to collapse, I'd still have a backup bank account with some funds from which I'd be able to pay my mortgage and other pressing bills on Monday morning. These are turbulent times that we live in, and turbulent times call for slightly different measures. I've also created a similar setup for most of our clients. Opening a bank account is relatively easy to do these days, and many of the larger, more established online banks even offer ones with no fee and no minimums. If you have a favorite bank to share and recommend, do let me and the other super savers know in the comments below who you bank with and what makes them so great. For the few clients who did not want to open another bank account elsewhere, we just had them set up a separate account at their brokerage firm to park some of their emergency savings in. It's really up to you which setup works best for your situation. And for my son, he's good-spirited and used to an occasional work fire drill. So we agreed to a homemade double-layer chocolate cake on a non-bank meltdown weekend. Hopefully this weekend. Fingers crossed. And for those of you who've asked about how to ladder some of your excess or emergency savings into treasuries, check out our latest video here on how we've done this for some inspiration. Because as I mentioned earlier, even if treasury rates moderate a bit in the short term, it's my personal expectation that the Fed will need to continue to raise rates at some point if they want to bring inflation down to their target 2% level. What do you think? How high will rates go? Drop us all a comment below with your prediction. And for those of you who are up to it, I'd also really love to hear how you're feeling after what's happened in the past week and what's making you nervous right now about your money. All right, Super Saver, I hope this video has helped give you some direction and peace of mind on how to protect and grow your money during these uncertain times. As always, if you enjoyed this video, then don't forget to share with those you care about, and of course, to hit that thumbs up, and see you again very soon with another brand new wealth building video.